said bonds versus stocks. Where should you invest in 2025? Mutt. In 2025, investors face a big question: bonds or stocks? Stocks promise growth and higher returns, but come with more risk, while bonds offer stability and predictable income, though often at lower yields. With interest rates, inflation, and market trends shaping the financial landscape, choosing the right mix is crucial. In this session, we'll break down the pros and cons of bonds versus stocks and help you decide where your money could work best in 2025. So before we start, make sure to hit the like button and subscribe to my channel. 1. Introduction to bonds and stocks. When it comes to building wealth or securing financial stability, investors have long debated between stocks and bonds. Both asset classes play critical roles in personal finance, corporate funding, and the global economy. Stocks represent ownership in a company, providing investors with the potential to earn dividends and benefit from price appreciation when the business grows. Bonds, on the other hand, are fixed income securities that allow individuals or institutions to lend money to governments or corporations in exchange for regular interest payments and the return of principal at maturity. In 2025, the decision between these two asset classes is even more complex. Due to shifting economic conditions, fluctuating interest rates, inflationary pressures, and global uncertainty. Investors must carefully weigh the pros and cons of each option, considering factors such as risk tolerance, time horizon, and income needs. Understanding the fundamentals of both stocks and bonds, along with how they interact in a diversified portfolio, is essential for making informed choices in the coming year. As we move forward, the balance between safety, income, and growth will be more important than ever in determining the best investment path. 2. The case for stocks in 2025. Stocks are often seen as the growth engine of an investment portfolio. They offer the opportunity to participate in the earnings and expansion of companies across sectors and regions. In 2025, global equity markets are expected to remain dynamic, driven by innovation in technology, artificial intelligence, green energy, and healthcare. Investors willing to embrace risk could see significant upside potential, especially in emerging industries. Historically, stocks have outperformed bonds over long periods, delivering higher returns that help beat inflation. However, this comes with volatility. Stock prices can swing dramatically due to geopolitical events, company earnings reports, or changes in investor sentiment. With inflation still a concern in many economies, stocks provide an effective hedge since companies can increase prices and grow revenues. Additionally, dividend-paying stocks can provide a steady income stream while also offering capital appreciation. For investors with a long-term outlook and the ability to handle market fluctuations, stocks remain a compelling option in 2025. However, careful selection is key. Blue-chip companies, exchange-traded funds, and diversified mutual funds may offer more security compared to speculative or high-growth stocks that carry greater risk. 3. The case for bonds in 2025. Bonds, in contrast, are widely considered the foundation of conservative investing. They are valued for their stability and predictable returns. In 2025, the bond market is shaped by central bank policies, interest rate adjustments, and inflationary trends. After a period of aggressive rate hikes in previous years, many economies are expected to stabilize, creating more favorable conditions for bonds. For risk-averse investors, bonds provide safety by guaranteeing fixed interest payments, often referred to as coupon payments, along with principal repayment upon maturity. Government bonds, such as US Treasuries, are seen as some of the safest investments in the world, while corporate bonds offer higher yields but slightly more risk. In times of stock market volatility, bonds often act as a safe haven, protecting portfolios from sharp losses. Furthermore, bonds can provide a steady income stream, making them especially attractive to retirees and those seeking financial stability. While bond returns may not match the long-term growth potential of stocks, they offer lower volatility and greater predictability. In 2025, investors may find particular appeal in short to medium-term bonds, as these instruments can balance yield with reduced interest rate risk. 4. Economic outlook for 2025. The investment landscape in 2025 is shaped by several macroeconomic forces that directly influence both bonds and stocks. Inflation remains a key concern, though it has moderated compared to its peak levels in 2022 to 2023. Central banks around the world, particularly the Federal Reserve, continue to adjust monetary policy in an effort to stabilize prices while supporting economic growth. If interest rates remain steady or decline slightly, bonds could benefit from price appreciation, while lower borrowing costs could fuel corporate profits and boost stock valuations. Geopolitical uncertainty, including trade disputes, conflicts, and supply chain shifts, adds another layer of complexity. Meanwhile, technological disruption and the green energy transition are reshaping industries and creating new investment opportunities. Investors in 2025 must recognize that both bonds and stocks will respond differently to these forces. Stocks may thrive in a low interest rate environment and during periods of economic expansion, while bonds may outperform during downturns or periods of heightened uncertainty. A careful analysis of the global economic environment is essential for determining where to allocate capital. Ultimately, the right choice will depend on how these forces interact in shaping risk and return across asset classes. 5. Risk and reward comparison. One of the most important aspects of deciding between bonds and stocks is understanding the risk-reward trade-off. Stocks generally carry higher risk, as their value is tied to company performance, investor sentiment, and broader market conditions. They can deliver substantial returns, but losses can be equally severe, particularly in the short term. Bonds, by contrast, are considered safer but yield lower returns. The risk with bonds typically comes from interest rate fluctuations, credit risk, the chance of default, and inflation eroding the real value of fixed payments. In 2025, this trade-off is more pronounced due to ongoing global uncertainty and technological disruption. Investors with high risk tolerance and longer time horizons may lean toward stocks, while those prioritizing safety and income may prefer bonds. It is also worth noting that diversification can reduce overall risk. Holding a mix of stocks and bonds can smooth out returns, as the two asset classes often move in opposite directions during times of economic stress. Ultimately, the decision is not about choosing one or the other exclusively, but about balancing them according to personal goals and market conditions. 6. Bonds versus stocks in different investor profiles. The choice between stocks and bonds is not one size fits all. It depends heavily on individual circumstances. Young investors with long time horizons may benefit from allocating more heavily towards stocks, as they have decades to weather volatility and capture growth. Middle-aged investors, balancing growth with safety, may choose a more even mix of stocks and bonds. Retirees or those approaching retirement often prioritize bonds for their stability and income. In 2025, with uncertainties still present in global markets, tailoring an investment strategy to personal goals is more important than ever. Risk tolerance, income needs, and investment horizon should guide decision-making. For example, a high-income professional with decades until retirement may invest 70 to 80% in stocks and 20 to 30% in bonds, while a retiree may flip that ratio to prioritize income and capital preservation. Furthermore, investors with specific goals, such as saving for a child's education or buying a home, may choose bonds to protect capital, whereas those aiming for wealth accumulation over decades may focus on equities. Understanding one's profile ensures that the balance between bonds and stocks reflects both financial goals and psychological comfort. If you liked this video and would like to see more like it, please give it the thumbs up. Leave a comment and click the button to subscribe.